as an active manager, you need to be invested on the one hand, okay? But the fact is that the market dynamics and the market structure actually afford the ability to hedge really almost like never before, because 5.25% interest rates work, A, because cash is attractive, but B, because selling call options against buying very cheap put options is about as attractive as it gets.
Are you basically saying that as an equity strategist for decades, you like bonds and cash?
Look, bonds is you have to differentiate between bonds and cash here, okay? And I think part of the error of the last year or so was this expectation that cash would become worth less, and what we're finding is that because inflation has remained stickier, cash has retained its value. Bonds are going to be what will work if there is a downturn, and I think that's part of the message of these last couple of weeks, is that there may not be a downturn, but there could possibly be sort of this growth scare dynamic.
So in other words, are you saying initially cash looked good, but you're moving out the curve because you do see some sort of deceleration?
Very gently, very gently. Our view is that at Evercore ISI, we do expect a slowdown at the end of this year into early next, and that's certainly going to be bond bullish, and it's certainly going to be part of the dynamic that causes the Fed to cut rates. But you really have only started to see these beginning signs of a slowdown. And what you're going to need to see is that inflation to fall in tandem with an accelerating slowdown, if that's the case.